As mentioned in the story, today's main topic is going to cover the top 10 redundant insurance products that I don't have. And since we just talked a lot about it, whole life insurance policies for children. We've got another Business Insider article on personal finance entitled, Should I Buy Life Insurance for Children? And I just want to highlight one thing from the article. This is under the section Alternatives to Life Insurance for Children. If you intend to ensure your child has life insurance options as an adult, verify your child rider policy can be fully converted into adulthood, as advertised for the Gerber plan. You should ask about guaranteed conversions just in case. On the other hand, if you're looking for a wealth building tool or savings vehicle for your child, a child life insurance policy is not the right choice. The available whole life policies are small, with limited, if any, options for early withdrawal, and other savings vehicles will generate greater returns and offer greater access to money when needed. That article also links to another one entitled, Here's Why Your Child Probably Doesn't Need Life Insurance. This article says, life insurance is only needed by people who have others dependent on their income, like parents of minors. Life insurance can also be used to pay off debts or be part of estate planning for ultra-high net worth clients. Notice that a newborn doesn't fall into any of these categories. Outside of the extremely rare case of the child supporting the family by being a child star, like a Gerber model or a voice actor for Bluey, you simply shouldn't buy your child life insurance. And I have to agree, but I want to tie up one loose end before we let the child life insurance policy topic go, and that's going to be being able to convert that policy into one that covers your child as an adult. The Gerber Grow Up plan advertised that their policy could be converted up to $100,000 of life insurance without a medical evaluation. If you were trying to get a policy, or your child was trying to get a policy to replace the income they were generating for people who were dependent on them, $100,000 is not going to make a dent into what they need. So they say that they're going to be working toward this, guaranteeing insurability in the future, but it's not really going to cover you for that much if you read the fine print. And if you have a policy that does otherwise and is able to get you there, know that the odds of a child becoming uninsurable, having dependents, and not having established some sort of life insurance policy prior to that, be it term or whole, is wildly unlikely. So guaranteeing future insurability for your child is not something that, in my opinion, you really need to worry about. The second redundant insurance product that I don't have is accident insurance. I've pulled up an article from Policy Genius. Accident insurance is a type of supplemental insurance that pays out when you're injured in an accident. It complements disability insurance by allowing you to claim benefits even if your injuries don't keep you out of work. It can also supplement health insurance if your injury requires medical care that your health insurance plan does not cover. Moving down in the Policy Genius article, we find that using accident insurance is purposed to supplement other insurance policies. They talk about accident insurance versus disability. The main thing that sticks out to me is that if you're injured and your injury isn't covered by disability insurance because you can still work, accident insurance might pay you out. Then they talk about accident insurance versus health insurance. And this is where my ears perk up because health insurance is expensive. Is this a way to make things less expensive on me? Injuries that qualify for accident insurance may not keep you out of work, but could still require some medical care. You can use accident insurance to cover a health insurance deductible or copay or any other services not covered by your health plan. For example, your health insurance will cover hospital fees associated with getting stitches, but your health insurance won't pay you any money for the injury and may not even cover your entire treatment. An accident insurance policy makes sure you get a small benefit to assist you with any incidentals or uncovered costs. However, accident insurance is not a replacement for health insurance and does not satisfy the ACA insurance coverage requirements. In essence, I want you to think about it this way. Health insurance exists to defer the risk for huge costs with health-related expenses that you cannot afford yourself given what you have in savings right now. Your deductible that you have and any other costs in and around an emergency should be covered by a fully funded emergency fund once you've made it to HopeFilled Financial FootStep number 4. And let's not forget that the purpose of insurance is to transfer risk that we can't take on ourselves to an insurance company. It's not to attain a payout for every little thing that might happen or something that we feel we would need help with. Let's move on to the third insurance product that I believe is redundant and that I don't have, and that's going to be accidental death and dismemberment. Here we have an article from NerdWallet just to explain what accidental death and dismemberment covers. On this website, they have an excellent little table that covers what term life insurance covers versus accidental death and dismemberment. Because accidental death and dismemberment is a life insurance policy that only pays out under specific cases. And that's because accidental death and dismemberment insurance only pays out if you die due to an accident or you're dismembered. They talk about death due to illness or disease, which is probably the very likely way that you would end up passing away prematurely. Term life insurance covers you, accidental death and dismemberment does not. Death from an accident like a car accident, both cover you. Death from drug overdose, accident, death, and dismemberment would not pay out. Death from drunken driving by the insured, term life insurance would pay out. Accidental death and dismemberment would not. Death from suicide, again, accidental death and dismemberment is no, but term life is yes, depending on your particular policy. And last, loss of eyesight or hearing or limb, that's something that life insurance isn't going to pay out if you're still alive because it's life insurance, term life insurance. However, accidental death and dismemberment will pay depending on the injury, and it's only going to be partial because you didn't die. Again, our goal with the life insurance policy is to say if we died, we want our loved ones to be able to be taken care of in absence of our income, or if we're dependent on a spouse's income. We want a policy on them that replaces their income so we can take care of the kids if that's our plan. Accidental death and dismemberment means that you basically have a restriction on the different ways that you might die, and it may not pay out when your family needs it. So it's not an alternative. If you have enough term life insurance in place that you are covered, you've got 10 to 12 times your annual income, or you've mapped out a plan where the death benefit could be invested to properly take care of your dependents, well, then why would you need accidental death and dismemberment on top of it? Because if you die, you're not double dead. And if you die due to an accident, you don't need to replace more of your income that's covered under term. I think it's completely and wholly and fully redundant. Let me know if you disagree with me, if you think there's actually a purpose here, an undue risk that we're exposed to that cannot be covered by any other means. The fourth insurance product that's, in my opinion, redundant and that I don't have is mortgage life insurance. Man, we're covering a lot of life insurance. This is a USAA article that I've pulled up that we're going to look into to see what mortgage life insurance is. It's from 2023. What is mortgage life insurance? Mortgage life insurance is also called mortgage protection insurance, MPI. It is a type of credit life insurance that covers your mortgage if you die before paying off your home loan. Mortgage protection life insurance protects your mortgage lender and can offer peace of mind. It protects the lender, not you. You'll know that your loved ones won't inherit a large debt, your mortgage, if you pass away unexpectedly. Let's take a step back for a moment and say that in your will you stipulate everything gets liquidated, no one gets to keep the house, and all of your net worth gets distributed to your heirs. Well, your estate, you're going to have an executor of your estate who will liquidate everything, pay off any unresolved debts, and then the balance, which is your net worth, is what goes to the heirs. Your loved ones are not going to be inheriting a debt. If you have a negative net worth, that debt doesn't get carried over to family and friends. It is forgiven. It goes away. In the United States, your children are not going to be inheriting a debt from you if they aren't keeping the house. Back to the article, it talks about how the payout, the death benefit, is equal to the mortgage. So it's going to continue shrinking as you pay down your mortgage. And the final word of the article, is mortgage life insurance worth it? It depends on your situation. If you don't think you can qualify for traditional life insurance, MPI might be a good fit. But it's important to keep the lack of flexibility in mind. Because the death benefit goes directly to your lender, it's the only financial help your loved ones will receive. You'll also need to consider whether the high premiums that usually accompany MPI work with your budget. MPI premiums can fluctuate. They're typically only fixed for certain periods of time and then can increase after that. It's responsible to think about how your family will cover mortgage payments if you die unexpectedly. But weigh all your life insurance options and make sure you're making the best decision to provide for your loved ones after you're gone. So now consider the case where you pass away and you have a spouse who's going to stay in the home with the kids. Well, they're going to still have the mortgage. If you have term life insurance, though, that is sufficient and mapped out to accommodate all deferred risk that you cannot take on yourself when you pass away, they should be able to use traditional term life insurance to pay off what's left of the mortgage and then use the rest to replace your income. You don't need a specific policy to cover the gap of your mortgage. And according to the USAA article, term life insurance is going to be way more affordable for the premium than MPI. Mortgage life insurance is simply expensive, and I really didn't like the idea that the premiums can fluctuate. I've gotten so many advertisements for this kind of stuff since becoming a homeowner. It is annoying, and they try to make it look so official that it came from somewhere where you're required to have this sort of thing, this mortgage life insurance. You're not. You're just going to get bombarded if you ever buy a place with these ads because they make a lot of money off of it. All right, the fifth redundant insurance product that I don't personally have is hospital indemnity insurance. What I have in front of me now is an article from Forbes. What is hospital indemnity insurance? Jumping into the heart of the article, you're going to find that hospital indemnity insurance is very similar to accident insurance, but it's specific to whenever you have a major payment due to a hospital. Hospital indemnity insurance provides a payout to you based on circumstances related to hospitalization or other specific healthcare services. Typical health insurance has specifications on covered services, whereas hospital indemnity insurance can be distributed in whatever way you need, i.e., it's a check cut straight to you if you went to the hospital for a particular service. This type of plan doesn't have deductibles, coinsurance, or network restrictions. Circumstances that would generally lead to a payout would be hospitalization, intensive care, critical care. Some hospital indemnity insurance policies also cover outpatient surgeries, ambulance services, and emergency room visits. Hospital indemnity insurance policies may also cover your spouse and family. This is another thing that I have run into in my personal experience with employer cafeteria plans. What doesn't hospital indemnity insurance cover? Hospital indemnity insurance does not cover medical care. Like health insurance, it is not a substitute for health insurance. It's instead meant to supplement a health plan. Supplement. Hospital indemnity insurance won't help you and your regular doctor visits and tests. It is meant for more serious medical needs, such as hospitalization. Hospital indemnity insurance policies also have limits, including hospital daily benefits set to a particular dollar amount. It could be $100 a day. It could be $1,000 a day. Hospital benefits limited for total days, such as 180 consecutive days. Intensive care unit benefits, which could be 200% of the daily benefit, for example. Benefit reductions to a certain age, such as 70. So as you get older, the benefits pay less and less. Now, I want you to consider this. It's not a need, it's a want. The payout, unless you're in the hospital for a ridiculously long amount of time, is not going to be significant. Well, I'd argue that it's more appropriate for us to make sure that we can handle our deductible using our savings, be it money we've set aside specifically for our health insurance deductible or our emergency fund. And if we do that, then this insurance is simply redundant to the emergency fund. It is not deferring risk that we can't take on ourselves. It's deferring risk that we should be responsible for. Coming in at number 6, cancer insurance. I have an article from healthinsurance.org pulled up because I want to share something with you. You'd think with the name cancer insurance that this is coverage to help you get through cancer if you're tragically diagnosed with it. What is cancer insurance, though? Cancer insurance, also known as specific disease insurance in some states, is a specific type of supplemental health insurance that pays a cash benefit for various cancer diagnoses and treatments. You can use the money to pay out-of-pocket medical costs and other expenses, including travel, lodging, meals during treatment, childcare, and home health services. Cancer treatment is intended to supplement a comprehensive medical health plan and is not suitable to be a person's only coverage for healthcare. i.e., if you get diagnosed with cancer or receiving cancer treatment, this pays you a lump sum, just like accident insurance and hospital indemnity insurance. But now we're even narrowing the scope tighter to being just cancer stuff. If we scroll down in the article, what doesn't cancer insurance cover? Cancer insurance policies are not designed to cover all of your medical costs a person may incur when being treated for cancer. The average cost of cancer treatment in the first year after diagnosis is $41,800, but costs can run much higher than that. Treatment of some types can exceed $1 million. The bulk of the costs of cancer treatment should be covered by major medical health plans, and no cancer policy can replace the need for major medical coverage, i.e., your health insurance has got you covered if you're going to need treatment for cancer. Now, I don't know of a health insurance plan that says, no, we're not going to pay things out if you have cancer. I know of some limitations, like for my cost sharing ministry, if you get diagnosed with cancer, you have to call them, tell them, hey, I've got cancer, expect that you're going to be seeing bills on this so that you can give them a fair warning. If you don't give them a warning, they might not work with you as easily. But the point being made here is that cancer insurance is redundant and it's meant to cover the sorts of expenses that you should be able to take on through your emergency fund. It is not diverting undue risk, and it's popular because cancer is terrifying. We hear cancer insurance and we think, I need insurance against that because if I get cancer, I don't know how I'm going to deal with it. Well, in reality, the undue risk you likely can't take on is covered by a good health insurance plan. The seventh redundant insurance product that I don't have is gap insurance. I have in front of me now a NerdWallet article called What is Gap Insurance and How Does It Work? What we're going to find reading through the article is that gap insurance is kind of like mortgage life insurance, but in this case, it's covering the gap between what you owe on the car and how much the car is worth if the car is totaled. So it's like life insurance on your car if you're upside down on the car. So imagine you had a vehicle that was worth $30,000 when you bought it. You drive it off the lot, you drive it for a year, now all of a sudden it's worth $24,000, but you still owe, say, what, $27,000 on it, hypothetically. Well, if you owe $27,000 and you total the car and insurance pays you the value of the car, your auto insurance, you have coverage on it and they pay you $24,000. Well, there's a $3,000 gap right there that you still owe the auto loan lender, and you need to get that money from somewhere. Let's just jump right to the question we all want answered. Is gap insurance worth it? You don't need gap insurance unless you lease a vehicle because the person who leased you the vehicle wants you to have that kind of protection, and in some cases require it because it's protecting them. Or you have a loan. You also don't need it if your loan is paid down below the value of your car. But if you have a lease or a loan, you may want to think about whether you can afford to pay the difference between the amount you still owe and the value of the car, if you have an emergency fund that's sufficiently built up. If you couldn't make that payment or don't want to deal with that financial stress in an emergency, then you'd probably benefit from having gap coverage. I want to say now, if you're following the HopeFilled financial footsteps, you have an auto loan, you're probably going to be at this point on HopeFilled financial footstep number 3, where you're paying your debt down, if not one of the earlier steps. So you're not going to have a fully funded emergency fund. Your starter emergency fund may cover the bulk of the difference unless you're really upside down on a vehicle. And if you didn't have gap insurance, but you totaled the car and you were upside down a lot, you didn't have enough emergency fund to take it on, you're just going to end up adding that debt, that difference from the auto insurance payout and the value of the car. You're going to add the gap onto your debt snowball. You're going to add it into HopeFilled financial footstep number 3, paying your debt down. And in most circumstances, I think that's a kind of risk that we can take on ourselves. If it were me and I were upside down, I'd probably want to save the difference on the premium for the gap insurance and just add that to my snowballs so I can get out of debt faster. The 8th redundant life insurance product that I don't have is actually one that's optional every time you rent a car, rental car insurance. And I've got an article here from caranddriver.com. Caranddriver.com says a couple interesting things, and they answer it straight up for me. They say, first off, some credit cards have rental car insurance built into them. So if you rent a car with a particular credit card it probably has the rental car insurance built in. Better than that, though, if you scroll down even further, they point out that a lot of auto insurance policies actually include coverage for rental cars. I know mine does. So understand your own auto insurance policy. If you have coverage for rental insurance, if you go and rent a car, you're covered with just your normal auto premium. There's no point in you buying the rental car insurance when you get there. The last time I went to go rent a car while we were traveling in California, I went there. They asked me, hey, you declined the insurance on the vehicle. Are you sure you want to do that? And I said, yeah, I'm pretty sure I want to do that. And they said, well, what kind of auto insurance do you have? No, they didn't ask me that first. They asked if I was sure. When I told them that I have USAA, they're like, oh, okay. They knew at that point that I had rental car insurance coverage built into that, and they weren't going to try to sell me on it anymore. But because I knew that and I was informed, they couldn't sell it to me. They tried anyway. Not very well, but that's the way this game goes. While we're talking about cars, let's move on to number 9, the 9th insurance policy that is redundant that I don't have. And that's going to be windshield repair insurance or windshield insurance. I have now a Forbes article called Here's the Car Insurance You Need for Windshield Repair. Need is, in my opinion, used incorrectly here. If we scroll down into this article, you're going to find little bits and pieces about windshield repair and how auto insurance ends up covering whether or not something is covered in the way of the windshield. And you'll find that auto insurance often has a $500 deductible, but it costs $250 on average for the glass cost replacement, meaning that with most auto insurance policies, your deductible is probably going to exceed the cost of replacing a windshield. For most cars, most situations, and most policies. Well, what does that mean? That means if you end up damaging your windshield beyond repair, meaning it needs replaced, well, your auto insurance isn't going to pay anything for it. It actually falls entirely, in that circumstance, in that example, on average, in your camp. But again, a $250, $300 windshield replacement should not be a risk that is undue to us. We should be able to pay for that sort of thing. It's not a massive amount of money that we'd be out if we had to go and replace a windshield. So why do we need insurance for it? Insurance exists to transfer undue risk that we cannot afford. Even your starter emergency fund should be able to cover this one. Last but certainly not least, the 10th redundant insurance product that I don't have is a home warranty. And here I have a US News article called How Does a Home Warranty Work? And I'm going to provide you this article for reference, but in the end, they cover right here in the middle, are home warranties worth it? Pros. They cover old appliances. This is what a home warranty does. You buy a home, they'll try to sell you one of these. In some cases, they might require it for the first year. It'll cover old appliances. It reduces out-of-pocket costs for repairs or replacements, and it helps sellers cover unexpected costs, or in this case, buyers. Helps a buyer cover an unexpected cost. Now for the cons. Requires service fees each time a claim is made on top of the monthly payment, the premium, if you will. It's not insurance, it's a warranty, but it's got a monthly cost. Doesn't generally cover pre-existing conditions. Wait a minute. It doesn't cover pre-existing conditions. Excludes outside contractors for the most part, depending on the company. So they restrict who can service you. You always have to pay a service fee when they send their guy out. And if they deem it a pre-existing condition that's not covered, they just don't cover it. Well, let's see, what does it cover? Electrical work, duct work, heating, interior plumbing, water heater, so a number of appliances and general building systems. Things that are typically covered in a home warranty include air conditioning, dishwasher, garage door opener, garbage disposal, oven, ranger, cooktop, refrigerator, spa equipment. And for the refrigerator, for some reason, it may exclude the ice maker. I guess ice makers break down as often as McDonald's ice cream machines. If we scroll down, what don't home warranties cover? Pre-existing conditions. I'm going to guess that means it's not like a detachable part of the house, like an appliance, a furnace, or a water heater. and it was a problem that was there. Improper installation and misuse. Oh, so if someone put something in wrong and it was damaged because they deem it improperly installed, they won't cover it. Or if you decided to misuse your refrigerator's ice maker. Home appliance or system still under a manufacturer's warranty. So if there's a manufacturer's warranty, you'll probably still pay the service guy to come out and look at it, but they'll just say, oh, I'm not going to touch that. Cosmetic defects, pest damage, which is something that your homeowner's insurance should definitely cover. New equipment that's been modified or changed, they're not going to cover it. Well, there are a lot of things I've tried to do myself. Last is secondary damage due to a dishwasher leaking or flooding from the kitchen. Again, something that you should probably have on your homeowner's insurance. And unlike some of the other policies that we've talked about today, this one can be a little bit more expensive. This one can run you on average $400 to $600 a year for the home warranty. I had one back when I lived in Utah. I had a condo. You've heard me talk about it before if you followed for a while. And if you don't follow, please follow, like, share, and subscribe. In this condo, I was told that I needed a home warranty when I bought it, and I was, as a new home buyer, not well informed enough about them. I don't even know if it was required of me to have it or if it was just sold to me. I renewed it the following year after the first year was up and looked at it as, what does this actually cover? I didn't really dig too much into it, but it was a warranty on the home. It was going to cover stuff, right? Well, one day the furnace started kicking on and then kicking off, then kicking on, then kicking off. Well, according to this policy, according to the home warranty, they're going to cover furnaces if the furnace has a problem. I haven't done anything to this particular furnace, so I have no problem calling them up. But just to have their guy come out cost a good little chunk of change. He came out, he took off the panel to the furnace and goes, yep, thermometer's dirty. He wiped it off with a cloth. Something I probably could have solved with Google. And I'm like, that's it? He's like, that's it. And then I got the bill for the service fee. I don't think if I called someone who wasn't through the home warranty that they would have charged me the entire service fee for coming out and wiping off the thermometer. This told me that if I had someone come out and I had to pay the service fee, I did the math, I did the break even, it wasn't going to make any sense. I canceled it and then eventually needed to replace the hot water heater shortly after. Well, the hot water heater was $1,000. Might have actually been a little bit shy of that. And that was in the emergency fund. I was able to take on that risk myself. And it occurred to me that the home warranty covers a whole bunch of things that I should be able to cover out of pocket. I don't think a home warranty is a need. I think it's redundant to your emergency fund, and I think the undue risk is covered under your homeowner's insurance policy. Well, that's it. Those are my top 10 redundant insurance products that I don't have and I don't think you likely need. Please tell me what you think about this in the comments below. Let me know if you get rid of an insurance policy that was redundant as a result of this episode. And if you disagree with these, you think they fit a need, they fit a common need that applies to many listeners, please let me know about it. I'd love to cover that in a future episode, either to correct myself or continue the conversation. And until next week, until next Tuesday, budget bravely and enjoy your hope-filled financial future.